Welcome everyone. We're just getting started, just after kind of 12:30. My name's Holly Piper. I'm at Fairfall Finance, and I'm really pleased to kind of welcome you to our webinar today on our new research on deduction lending. I know a few more people kind of are joining, but we're going to kick off now because we've got an awful lot to get through today. So I am delighted to be joined by the researchers who did this research, so Gareth Evans and Mick McAteer, who you'll hear from shortly. We're also joined by Karen Bennett, Chief Executive of Enterprise Credit Union, to give her perspective. And at the end, we hope to have a really lively kind of Q&A, and my colleague Finn Sharp will be joining for that as well. A couple of bits of housekeeping just before we get going. Any questions for any of us? Please kind of use the Q&A. You should be able to see the tab at the top of your screens. It would really help us if you could add in your name and your organisation when you're asking a question, just to make sure we kind of answer it as fully as possible. Whilst the Q&A is at the end, please feel free to kind of post your questions throughout. We've got an awful lot of people joining the webinar today, expecting over 100. So have the best chance of getting your question answered. Please kind of pop it in the chat, and we'll be publishing those questions kind of at the end and kind of giving those answers at the end of the Q&A. We will expect to take the full hour today, but I will close just before 1:30. And for those of you who are looking kind of to see the research, that will be published on our website kind of right at the end of this webinar. We thought it would be too distracting to publish it now, so we'll publish it right at the end, and we'll put the link in the Q&A so everyone can kind of see that. Right, so without further ado, assuming I've not forgotten any major housekeeping, I'm just going to kick off by introducing kind of Fairfall Finance. So as I said, I'm Holly Piper, so I'm Investment Director at Fairfall Finance, and as probably quite a few people, but probably not everyone on this call knows, we were set up through the government to make the financial system fairer for everyone. So we're a dormant asset organisation. So what that means is we've been given about 100 million to support the 17.5 million people in financially vulnerable circumstances across the UK to have better access, fair access to fair and affordable financial products and services. And we do that by working with the financial services industry and working extremely closely with the whole of the community finance sector to really ensure that kind of the provision of affordable credit is kind of scaled up. We've got huge ambitions there and are working really closely with lots of the organisations on this call to do that, partnering really closely with banks and financial services providers. Because actually there's a huge opportunity for them to serve these customer group more, and also doing a lot of kind of new products and new products and markets development. So some of you might have heard of our no interest loan pilot. We've also got a consolidation lending pilot, and kind of lots more to come as well. So that's us as a kind of an organisation. But it brings me to kind of our research today. So with the research we published is on deduction lending, and it's probably worth just touching on what we mean by deduction lending. So that's our shorthand term to describe two types of lending. So as lots of the credit unions in this call will know, for many years, credit unions have had payroll partnerships with employers where loan repayments are automatically deducted from the borrower's salary at source. So that's one type of deduction lending. More recently, some credit unions, including the ones who participated in our research, have applied the same deduction model to non-means tested child benefit. And those are obviously known as kind of family loans. So to kind of give that a little bit of an example, and with apologies for those of you on the call for whom this is blindingly obvious, but working on the assumption there are some people who are perhaps less familiar with this. A single parent of 2 primary school age children might take out a £500 loan to pay for extra childcare costs over the summer, 2 sets of new school uniform, some new school shoes. And from there, roughly £157 per month child benefit for the 2 kids, they'll repay £63 per month. So they'll borrow this money and they'll be repaying at that rate. And they'll also, for example, with lots of the credit unions are working with, be saving at the same time. So from their child benefit, they also might be putting £10 a month into a savings account. This leaves them with £84 a month remaining from that child benefit to kind of withdraw and spend as they wish. And at the end of the 9-month loan term, they'll have repaid the loan, and they'll also have £90 kind of saved up. There are quite a lot more examples in our kind of research as well, but we thought just helpful to kind of start with something so everyone knows kind of we're on the same page. Now, whilst we'd heard many positive stories from borrowers about their experiences of deduction lending like this, there was little in the way of formal research. And we were also aware of concerns raised about this lending model, particularly by some of those in the debt advice kind of sector. So we really wanted to test really thoroughly how the model worked and to ensure it's delivering the best outcomes for borrowers. And our hypothesis was that this type of lending, so deduction lending, enabled more affordable credit to be provided, which is something we know is hugely needed at the moment. It improved savings behaviour, so enabled more borrowers to save, and had really positive outcomes for people in vulnerable financial circumstances. And we commissioned this research to test these hypotheses. Which brings me on to the next really important bit, which is some thank yous. So this research was only possible because of the 7 brilliant credit unions who very generously gave up their time and really participated really fully in this research. So a huge thanks to Advance, Clockwise, Co-op, Enterprise, Leeds, London Mutual and Manchester Credit Unions. Hopefully I've managed to say them in the alphabetical order. And also big thank you to Paul and Nick at the Swoboda Research Centre and to Matt, Gareth and Nick at the Financial Inclusion Centre, who conducted a really thorough and wide-ranging review of deduction lending. I'm now delighted to hand you over to Mick McAteer and Gareth Evans to take us through this research. Gareth, over to you.
Thank you, Holly. So, as Holly outlined, our research looked at how well deduction lending was working for the lender, in the case of payroll deduction, the employer, but most importantly, the borrower on low incomes. We looked at low value lending, so less than £1,500, as people at that borrowing level tended to have lower incomes and be less well served by the credit market. So building on the initial literature review, we undertook an extensive borrower survey across the 7 credit unions, which responded back to 7,559 completed surveys, about 20% of the total people who had borrowed during the time frame. And importantly, we looked at payroll deduction, child benefit lending, but also what we classified as standard loans, so those using direct debits, standing orders, or cash repayments. And so we looked at those results, and Mick's going to introduce those in a second, but we also spoke to 20 borrowers as well. And so I really wanted to start by introducing...
So I've been a member from...
So I wanted to start with an introduction to one of those case studies. So Natalie, not her real name, but is a Clockwise member, and very, very typical of the child benefit borrower, being a young mother under the age of 24 with 3 children. So Holly, if you can.
So I've been a member from about 2 years ago now. I was in temporary accommodation before I moved into my actual tenancy.
Yeah.
And obviously I was referred by a friend, one of my friends. They said, obviously, if you go to Clockwise and they basically help you out, you can pay it back monthly through your child benefit.
Yeah.
And it's just, to be honest, it's just easier for us because, you know, it's reliable. It's not stressful, you know, having to make repayments because obviously it already gets taken out.
Yeah.
It gets taken out without us even having to pay it, if you know what I mean. So I had a doorstep loan before I used Clockwise. But like I say, if I'd have heard about Clockwise before, I'd have just come straight to Clockwise like there and then. Yeah, with a doorstep lender, it's a lot of pressure. They will come out to you. They know who you are. They kind of know your circumstances. I know Clockwise know your circumstances because you have to fill out applications. But like I say, it's if you think about it, it's anonymous. They don't know who you are. And I find with doorstep lenders, they can become quite, when it comes to money, they can become very, I wouldn't say aggressive, but I'd say, I don't know what the word is.
Just persistent.
It's just helpful because, you know, every like I say, we don't have to stress about paying it back. It automatically gets paid, and then what child benefit we have left gets put into either our bank account or into my Clockwise account. And just the fact that it's, you know, every 4 months, if I am running low on money, then I can top up if I need to.
Yeah.
So that's a really good benefit for us. No, not at all. I've not had a negative experience with Clockwise. Obviously, at the time when you need money, it is quite stressful having to go through the process. It does feel like it's a bit of a long-winded process, but you know, once you've signed the agreement, you know, your money's in there and then.
Yeah.
I've never really had a negative experience with Clockwise. All I want to say is that, you know, it is helpful for people that are on benefits, because a lot of people that need loans, because they're on certain benefits, they're not eligible for these loans. So the fact that Clockwise is, you know, there is a place that if you are on benefits you can go to, and they don't discriminate. It's just really helpful.
So hopefully we're going to hear some fantastic statistics in a moment from my colleague Mick, but really it's those stories and those positive endorsements from people like Natalie that are really, really important. So if we could just move on to the next slide, please, Holly. So in terms of the methodology, as we said, it's those interviews with both people who've had positive experience but also a negative experience were key to bringing some of those statistics from the surveys to life. But importantly, we wanted to make sure we heard all the voices from across the sector. So we also conducted stakeholder interviews with 26 industry experts and different organisations from the participating credit unions, other lenders across the community finance and commercial sector. Importantly, the debt advice sector, other trade bodies and policy stakeholders, and then finally the employers as well. So hopefully a comprehensive piece of research that I'm going to hand over to my fellow director, Mick McAteer, who will be able to take us through the findings.
Yeah, many thanks, Gareth, and thanks again to Fair for All Finance for funding this research, and particularly as well, thanks to the participating credit unions, because it has allowed us to build up a really large-scale research project to investigate some of the hypotheses there that Holly was talking about. And before I quickly go into the findings, can I just say, look, I mean, you know, we're very, very conscious that for many people, any form of borrowing, no matter how fair or affordable, will not be the most appropriate thing. There's better ways of doing this, but at the same time, as Holly pointed out, you know, there's clearly a need for some kind of fair and affordable loan product to take on the high cost short-term credit providers. And so what we're doing with this report really is, you know, we were very conscious, you know, we're very aware that there were concerns about deduction-based lending. So we really wanted to try and address some of those concerns head on, you know, and as you say, if you get a chance to read the report, I think we've taken a very robust, I think, you know, quite a challenging approach to testing those hypotheses as well. But what the findings do show really is they are very, very positive, both for the borrowers, for the credit unions themselves, and in the case of the payroll deduction loan for employers, which backs up previous research we've done about payroll lending. And I think for credit unions as well, one of the things we were looking at, Gareth and I, was at how do we help credit unions get more loans out the door, for example. I mean, in 2021, the ratio of loans to you know, outstanding shares held by credit unions was 62%. That's actually down from 68% in 2017. So again, we came at this sort of from the perspective of looking at what the benefit for credit unions is as well. Now, just quickly, if I think it would help to understand the profile of the child benefit loan borrowers, just to give you a flavour of the kind of the market here we're looking at, and to help you understand why this is such a good product for, you know, for targeting priority vulnerable groups. In our sample, you know, 7,500 people responded altogether. Not everybody responded to every question, but 97% of the users of child benefit loans were women. 52% of the people who used the child benefit loan were between the age of 18 and 34. 90% were renting, with obviously a minority only homeowners, and only 42% were working full-time and part-time. That's much lower, obviously, but perhaps not surprising than payroll borrowers and standard loan borrowers. They were predominantly from the lowest income groups in society. They're much more likely to be single parent, and they had more children than the other borrower types as well. And as the report points out as well, when you look at the analysis, they have many fewer traditional borrowing options than our other borrowers, who use the standard loan, or indeed who use traditional forms of lending like credit cards and overdrafts. So the profile of the people who are using the child benefit loans particularly are very much, as I say, priority groups for any financial inclusion strategy. And I think this is why some of the findings in the research are all the more powerful, given the profile of the borrowers themselves. Now, just to I won't go through everything. The report's very complicated. It's about over 100 pages long, but just some of the key findings was that one of the concerns was that people says, well, maybe people won't be satisfied with this type of loan. What we did find actually was almost overwhelmingly people said they were satisfied with their loan. And I must say that was across the piece, wasn't just with child benefit loans. It applied to payroll and payroll deduction loans as well. When it comes to child benefit loans, 91% of people said they were comfortable about transferring their child benefit to their credit union. And again, we're very conscious that that's been raised before as a possible concern. And when it came to savings behaviour, I think one of the strategies, one of the things that Fair for All and others keep stressing is this is not just about borrowing fairly and affordably. It's about helping people save to actually build a cushion against future needs to borrow. But we did find that actually 7 out of 10 respondents said it helped them save more regularly. And again, the findings were actually even better for child benefit borrowers. 73% of those said they were saving more regularly compared to 66% of the standard loan borrowers. And payroll borrowers as well, 72% of them said they were now saving more regularly. So the child benefit and the payroll loans were actually help more people save on a regular basis. And I think what was really interesting was that 72% of the child benefit borrowers had said they had never or rarely saved before they'd taken out their child benefit loan. So again, the evidence does suggest really here that it isn't just really a good way of providing fair and affordable lending. It is a good way of encouraging savings behaviour that has longer lasting effects. And again, not surprisingly, when you look at sort of the impact on stress and so on, 6 out of 10 respondents said they felt less stressed or anxious or depressed after taking out a loan. And to be fair, again, that was across all 3 different product types as well. Sorry, could I quickly move on to the next slide? Yeah, and we also looked at the impact on the credit unions as well. I mean, you'll not be surprised to hear that data was very difficult to come by on this one, but we were able to thanks to one particular credit union, they let us look in more detail on the sort of the arrears and write-offs on different types of loans. And what was very interesting, it didn't really matter how you sort of measured the ratio of write-offs and whatever, whether it was on as a proportion of outstanding loans or as a proportion of loan approvals or whatever. There are significantly fewer write-offs as a proportion of outstanding loans or loan approvals with the child benefit loans. Next in line really comes the payroll loans. They had very low levels of write-off as well compared to the standard loans. So both the deduction-based lending products had much lower write-offs and levels of arrears than the standard loans as well. And again, we found that actually, interestingly, for this particular case study, the acceptance rate for the family loans, the child benefit loans, was very much higher than it was for the standard loan as well. So again, as I say, I appreciate this is very much based on a case study rather than sector-wide analysis, but it does suggest very strongly that some of the fears about the risk associated with providing child benefit loans might not actually be that problematic when you look at it in detail. Sorry, next slide, please. Yeah. Yeah, and just on particularly on the case of the payroll deduction loans and what happened in relationship with employers, what we did find as well was that 82% of borrowers reported no change with their relationship with their employer. Again, we were conscious before with previous research we've done on payroll lending that there was a concern that workers might be reluctant to have a payroll savings loan because of the related. They didn't want their employer knowing too much about their finances. But again, we didn't really see any significant concerns about the relationship with the employer. And indeed, 86% of people responding said they were confident that their employer did not know too much about their personal finances. And the reason we've included a figure there, about 7% of borrowers said they had struggled with household finances since the loan started. And again, across the piece in the 3 different product areas, we actually found that actually very, very few borrowers said they were struggling as a result of taking out loans. And again, this is particularly relevant for the child benefit and for the payroll lending products, because there's concerns that the benefits of the automated deductions, which has significant advantages in terms of cost and efficiency, whatever, could have unintended consequences in terms of making people struggle. But we actually found very, very few borrowers, either in the child benefit loan or in the payroll savings-based loan, deduction loan, were reporting that they were actually experiencing financial difficulty as a result of the automated deduction of payments, whether from their child benefit or from their salaries. So I think that's me. Thank you.
That's great. Thank you so much, Mick and Gareth. And we'll be hearing from them both a little bit later. But for now, I'm going to hand over to Karen Bennett of Enterprise Credit Union.
Hi, everyone. I hope you can all hear me. My name's Karen Bennett. I'm the CEO of Enterprise Credit Union. Can I have the first slide, please, Holly?
I think first joined must be maybe 3 years ago. It was around a time where, no, it might have been just before that actually. I went through quite a bad breakup with my ex-partner of 8 years, to the point that I had no money for 6 weeks.
Okay.
So I'd gone from going from income support to universal credit. So obviously when I did start getting my money through, I had to pay back people that I'd borrowed to get back on my feet, if that made sense.
Yeah.
But typical, you can't guarantee what's going to happen in the world. My fridge freeze broke not long after I started getting back on my feet.
Yeah.
And with having 4 children at the time and being on my own, it was quite difficult. And it was only a neighbour that recommended yourselves to me.
Okay.
That I come to yourselves. I didn't even know you existed before then, to be perfectly honest. Prior to that, God, I think I used to have a doorstep lender that used to come.
Yeah.
I used to use them. I don't use them no more. I used to use Bright House. I've not used them for 5 years.
Yeah.
Because I'm at the point now where, with me having all the kids, if we can't afford it, we don't get it. I feel safer using you guys than I did using the doorstep lenders. Only because of the fact that obviously I'm saving at the same time. So obviously while I've got a loan with you, I'm also putting money into my savings. So when I do pay that loan off, I've also got a lump sum to fall back on. No, I was rubbish at saving. I could never ever save. Not a lot what I put away, but it's better than nothing. If you know what I mean. I think there's about maybe £200-300 in there.
Yeah.
Of savings. I'm looking to save £50 to £100 a month.
Yeah.
With us having 5 children, because we get nothing for my youngest.
Yeah.
So it's hard. It's even harder at the minute with obviously all the bills and the gas and electric going up, because we're scraping by at the minute.
Yeah.
Do you know what I mean? So there's no rainy day fund as we used to have to go out. There is none of that because of everything that's going up. So to know that I can still save monthly by paying you even what I'm paying, it helps that a little bit.
Yeah.
If that makes sense. I honestly can't. I know some people go, oh, well, why did you want the child benefit? To me, it doesn't.
Yeah.
Yeah, they know what you're getting, but at the end of the day, everyone that has children gets the same amount. So it's not as if one person's getting different. If the same person has 5 children,
yeah,
every single person that has 5 children is going to get the same amount of child benefit.
yeah,
So it doesn't bother me, to be perfectly honest.
yeah,
It'd be different if they were taking it straight out of your bank balance, but it's not. You've still got quite a bit of privacy,
yeah,
if you know what I mean.
yeah,
Because they're not asking for your ins and outs and everything else. It's just your child benefit.
yeah,
And like I said previously, at least you know if they're getting your child benefit first, taking what you owe, and then giving you the rest, you know your bills are paid. So it's never been a negative thing for me. If anything, it's always been a positive thing. I'd just say not to look at it negatively. Obviously, a lot of people at the minute rely on the child benefit to help with just day-to-day stuff. But say, like I said previously, if worst case scenario, something happens, you don't have the money, you can't get any help from anywhere, at least you can help people. Yeah, you might have to wait a couple of days, but providing you're willing to use your child benefit and know that your loan is being paid every month and get the rest paid back to you, at least you've got that safety net.
yeah,
It's always better to know that you've got a safety net and you're not getting yourself in hundreds and hundreds of pounds of debt. You know your bills are being paid every month, than going to some random person that will probably charge you a hell of a lot more and you don't know just how safe you are.
yeah.
At least with a credit union, you've got everything. And you know that they're a lot more reliable than anywhere else.
Gareth, do you want to just give us a quick summary of that case study and then we'll hand straight back to Karen?
So yeah, thank you to both Natalie, the first case study, and that case study, Rachel, who was a family loan user of the last 3 or 4 years with Manchester Credit Union. Again, a young mother, I think 5 children, and on a very low income. So again, just the stories you hear are typical of some of the case studies that we spoke to during that. And I'll hand over to Karen, who will be able to tell you about the experience up in Enterprise and some of the examples that they've helped. So over to you, Karen.
Hi, thanks, Gareth. Go to the first slide, please, Holly. So I started earlier saying I'm the CEO of Enterprise Credit Union based in Liverpool. I just want to give you some perspective from the lender's point of view, but just to give you a bit of an insight on the background of Enterprise Credit Union. So you can see there we have assets of just under £40 million. Our loan book is £31.7 million and our shares are £31.4 million. So we are over 100% lent out on from our shares. We have membership of just over just under 22,500 members. Our capital to asset ratio is just under 20%. The maximum interest rate we charge on any of our loans is 26%. 93% of our loan book, however, is all either 14% or below. Our bad debt rate is 1.83%. And you can see there, I put on the right hand side a little bit of insight into child benefit. Our growth came from child benefit loans back in 2007. We were the first credit union to sign a contract with the DWP Growth Fund, and we received just under £165,000 capital along with some revenue grant. That accumulated over a 4-year period from DWP to just under £1 million. Since then, I said, we've been using this payment for thousands of our loans, but not just starter loans, not just family loans. It's also used in standard loans, Loyalty Plus, and other loan products that we offer. Around about just under 50% of our repayments come from child benefit. I think one thing I do want to say, since we've done that in 2007, we have issued and have had repaid £140 million worth of loans over that period. It was an absolute and also the best thing Enterprise Credit Union done. We could reach more members and we could accept a hell of a lot more loans as well. So it was a godsend for many, many of our members there. So I'm just going to give you a little bit more insight into case studies if I can, because we're very conscious in Enterprise Credit Union that when we get a member, we want to keep them for life. So a lot of these, I'm not going to go through every word of these, but I think the slides will be available. 12 years ago, we had a young lady who lived in a hostel, similar to the background we heard earlier on that tape there. You know, when she's looking for a loan, she was given a £500 loan. The way we'd done it with the child benefit at the time, she had 3 children. It was a weekly child benefit, £47.10. She paid the loan off by £12.10 a week. £10 on her choice on the shares, and then the remaining £25 was given to her the same day as a bank transfer. Since then, she's undergone, honestly, you want to see this girl, she's done like remarkable. She now has over £2,000 in shares, you know, and I think that's all down to us encouraging those savings as she's gone along. She's furnished her home, she's been on multiple holidays, put her kids through college and university, and her daughter, who was now a trainee solicitor, is a testament to Sandra herself, but also as well knowing that we've helped her get along, you know, come along that journey with us. So she's been with us now for 11 years. She no longer receives child benefit, but she does pay in by standing order. She used the credit union to save, and she withdraws once or twice a year. Yeah, but she's also got a small, like, pot that she's saving up for the long term. So you can see there that member's journey. We've helped that member through the child benefit, you know, come through that journey with her, you know, and turned her life around. So the next person on the next slide is a very similar. So Jenny again, you know, she's 29-year-old mother of 2. She's been with us again since 2012. She was also financially illiterate, but she couldn't only read or write, and she was really in a bad way when this girl come along to us. And again, you can see what's happened with Jenny over the years. She's borrowed and repaid over £41,000 with this credit union. You know, she certainly has worked hard, and we work with her to improve her credit score. You know, and she has, you know, she comes in and says, oh, I could get a bank loan, but I prefer to stay with the credit union. You know, I like it. And she says there, you know, she likes the flexibility of being able to repay the loans early. There's no hidden costs, you know, and she finds the rates, you know, second to none. The last person is the next slide. Here's a young girl called Karen. She's only been with us for just under 3 years now. And again, she applied for the starter loan, you know, for Christmas for the kids, for a little one, I should say, you know, and she was receiving, I think, £21.15 a week. So we set the loan, you know, so that after affordability, making sure that she could afford it, there was no stress to her, you know, and so she's on £9.15 a week, and then she started saving £2 a week. But it's building up, you can see there, it's building up. You know, she's borrowed roughly 5 times during that period, you know, but she's working full time now, this girl, and she's one of our payroll deductions with our local council, you know, so we're delighted with her. She's saving towards a deposit for a house, and she's determined to do that. One thing I do want to get across, the credit score, and you'll see this in the report, but her credit score since she's been with us has increased by 85 points because she's maintained the credit and so on and so forth. So, and I'm, you know, she said as well, I think, you know, it's really valuable that she's come back and said that wouldn't have happened otherwise, unless we at Enterprise Credit Union were sharing a credit score, you know, not just doing the credit for the sake of looking at sort of past history, but we were working with her to build up her credit score as well, which was another bonus. So I think that's just 3 sort of little things you can see, case study you can see there. You know, and I'm sure when you go in to the report, you're going to see lots of fantastic examples, you know, not from Enterprise Credit Union, there's like lots and lots of credit unions showing there, you know, and I just, yeah, that's all I want to say really. Just want to finish, you know, by saying it's a payment method. Child benefit is a payment method. You know, we do cash, we do standing order, we do payroll deduction. It's a payment method. But I'm going to hand you back now, but thanks for listening. Thank you.
Thank you, Karen. And so I'm just going to sum up the conclusion of the research, and then just focus in on some of the recommendations. So overall, the research proves that deduction lending model, either via payroll deduction or via benefit deduction, is extremely popular. It's advantageous and overwhelmingly positive in terms of the beneficial impacts it delivers for low-income households. It's helping foster financial improvements and wider health and well-being benefits that we've heard from, as well as encouraging those positive saving behaviours. And as well as evidencing the benefit for the borrowers, it's really clear that the deduction lending is positive for the credit unions themselves, enabling them to deliver low-cost lending to more financially vulnerable households who might otherwise have few options beyond high cost and more disadvantaged subprime lending. Therefore, our report shows this clearly and evidences that, and then also looks at 17 recommendations that attempt to bring together good practice as well as what other stakeholders can do to scale deduction lending. So the first of those recommendations is that we feel that more employers should partner with credit unions to deliver payroll deduction schemes to their workforces. So again, we've seen this as a powerful way of not only encouraging savings through payroll, but also as a mechanism for deduction of loan repayments. And that means that we want more policy stakeholders to be pushing payroll deduction. So business organisations, trade bodies, funders, central government, local government councils and other civil society organisations should all be promoting this and all doing this for their own employees as well. The third one is around the benefit deduction lending. And again, if a stakeholder is really wanting to work with financially excluded people and provide affordable access to credit, then we really feel that local authorities, social housing providers, government departments such as DWP should be working with credit unions to really promote access to benefit lending as a viable and beneficial solution to giving access to affordable credit. So we've heard about some of the tensions between the debt advice agencies and some of the local credit union, and so we really feel that those two sectors should be working more closely to understand the benefits that each other deliver and agree in more productive ways of collaborating. Equally, some of the research and findings show that there could be improvements to the mechanism, particularly around benefit lending itself. And so we hope that this will stimulate discussions with HMRC and DWP to work with the credit union trade bodies to sort of formalise and streamline some of the notification and waiting periods so that we can reduce and limit some of those barriers. And then finally, the majority of the recommendations in the report focusing on good practice within the sector. So there's a good practice document that we've generated as part of the research that bring together everything from loan assessment and credit and affordability checks, repeat borrowing, identifying and supporting those in financial difficulties, things around marketing and promotions, and finally additional products and developments that could be taken forward with both payroll and benefit lending. So that's it from the formal part of the session today, and we're going to move on to questions and answers. So hopefully there's going to be some really stimulating questions that have already been presented in the Q&A section. And I'll hand over to Finn, who I believe or it may be Holly, who will be taking us through the next stage.
Yeah, Gareth, thank you so much. And yeah, as Gareth said, we're joined by my colleague Finn Sharp, who's been instrumental in this research, and Gareth and Mick and Karen are kind of staying on for the Q&A as well. We're also running perfectly to time, which means we've got lots of time for kind of questions. We've had a lot coming in, and please do kind of keep adding them into the chat. If I kind of start off with one from Sarah Williams from Debt Camel, and again, apologies if I mispronounce anyone's name, I do apologise in advance. Sarah's question is around kind of credit unions' child benefit loans. Do all the credit unions explain clearly, e.g. on their website, what a borrower has to do to halt to the child benefit being paid to the credit union if the loan has become unaffordable during the loan? Finn, do you want to start us off on that question?
Yeah, thank you. So as Gareth was saying, we've tried to take what we've in this research, we've had some really positive results. It's with 7 credit unions who from the research seem to be doing a great job. We've tried to take what they're doing, but bringing in the consultations with stakeholders to come together with some good practice for the sector about how to do this kind of lending. So there was a couple of points of good practice that are related to this. We really think it's important encourage people to reach out to their lender, proactively making clear that there is help available when there is financial difficulty, making clear that there is flexible forbearance policies in place. We do say that credit unions should make this account information when they're setting up where the money is going clear up front when they set up these loans, and it should definitely never be withheld if somebody is asking for it. I think as Mick was talking about through this research, we didn't find, looking across different kinds of loan, payroll lending, family lending and normal loans paid through direct debit, we didn't find a difference in the levels of difficulty that people were experiencing. That suggests that participating credit unions are doing this part of it quite well, and I think that's kind of why it's so important to learn from this research.
Thank you, Gareth, Mick, Karen. Anything from you guys to kind of add to that?
Yeah, so I can come in. I'd say it's sort of, same with any lender. We sit with credit unions. It's very clear, to contact the credit union if anyone is in any type of financial difficulty, not just with child benefit payments, but every type of payment. And what we do speak very clear when you do the affordability assessment. That's first and foremost when we set that payment up. If someone does change circumstances, again, the members know they can come to us straight away.
I think just from the results from the surveys, as Finn pointed out, there was no real differences in terms of missed payments or wanting to have missed payments or struggling to keep up with household payments across the 3 different types. But there was discrepancies between awareness where you could stop the payment, but actually it wasn't the child benefit borrowing that was the lowest. It was actually payroll deduction. So people had less understanding how they would stop a payroll deduction compared to the child benefit lending. But again, that's one of the recommendations, as Finn pointed out in the research, that all credit unions should be sort of promoting that they're there to support people in financial difficulties, and they should be able to support them, but also making sure that they're aware of how they might go about stopping a payroll deduction, a standard loan, or a child benefit loan.
Yeah, I think related to that, there was a question around the negative experiences. We've been talking a lot about positive here, and as I said, those were the findings from overwhelmingly from the research that we conducted. Of course, that's 7 credit unions. We can't speak to every single case out there. I think on that point, Gareth, I know that was one of the areas that was trying to be explored through the survey, and then speaking to interviews to try and get deeper into what was behind people's experiences. So maybe you can talk about, was there another side to things?
Yeah, well, when we did the survey first, and then we asked people if they'd be interested in speaking to us about either a positive experience or a negative experience. And so we actually really, given the people that agreed to do that, it was about half of the people complete the survey. We really struggled to find points where people were disappointed by or struggling and had a negative experience. Often those poorer sort of experiences came from administration issues, or just like that somebody hadn't been given another loan, or whatever it might be, rather than the actual mechanisms themselves. So that's my sort of takeaway from the qualitative research that we did in terms of the research. And Mick, have you got any reflections on that?
Yeah, look, I mean, I think when we started on this work, I mean, we were working on the basis that automatic enrollment, or whatever form it takes, was very successful when it came to pensions, for example. Automatic enrollment in pensions has been one of the few successful policy interventions, and since I've been campaigning for the past 25 years, So the question we posed was, look, can the same principle of automatic deductions be applied to make loans more affordable and fair both for the lender and for the borrower and for anybody else involved in the system. But we were conscious that it came with risks, you know, and that's why this report was designed. Before we even started designing the questions, we tried to identify what were the particular concerns that people might raise with this form of lending. Now, not every credit union will have the same risk appetite as the credit unions that are involved in this study. Nevertheless, I think the findings really do give comfort to people who were concerned or who might be concerned about this particular form of lending, both for the borrower and for the credit union itself. I think the one thing that really jumps out at me is that, you know, as a former board member of the FCA and as someone who looks at risk all the time, when you look at the profile of the benefit loan borrowers, you know, when you think about it, predominantly low income, most of them rent, you know, they're single parents with sort of, you know, more children than average or whatever. That is the sort of in most cases you would think, oh my God, you know, these borrowers are going to really struggle to actually make ends meet if they actually borrow any money whatsoever. But, you know, when you think about the risk profile, for me, that's what makes these results all the more interesting, because the positivity of these results, given the risk profile of the borrowers, I think reinforces the view that this is actually a very fair, affordable and efficient product, both for the borrower and for the lender.
Great, thanks all. We've got loads of questions, so I'm going to try and make sure we get through a few more. So going to Rachel's question from the Joseph Browntree Foundation, who says, great to hear about some of these positive experiences. I'm interested to hear more about any examples of those for whom the loans haven't worked out as well, falling into negative budgets, etc. Also interested in levels of declines for family loans or payroll loans and more detail around the affordability assessments. There's quite a lot there, but Karen, can I go to you first?
Yes, no problem. Thanks for that question. I'll pick up on the affordability assessment if I can. So I'd say, you know, we do our best, you know, to ensure that the member doesn't miss that money coming in. We work with them over the 10 to when we do a review after 10 weeks, make sure they're all okay with those payments coming in. So the member's quite happy to continue with those small amounts that they're paying. I think the fact that they're getting a big chunk of it back as well, you know, if they've got 3-4 kids, they need that money. It's there that morning for them. I also, if I can pick up on forbearance, I heard the word forbearance there. We have a lot of members we have to work with, you know, with financial difficulty, you know, and we will do forbearance, we freeze interest, reduce payments, give them the child benefit back, whatever we can do to make sure that that member's not financially in difficulty. We will work with the member, every member on that, not just the child benefit payments as well. I hope that answered it. I don't know whether I missed anything off there, but I'll leave it to someone else.
There is pretty full. Nick, Gareth, anything from either of you?
I think just on the affordability point, like all the participating credit unions were undertaking, you know, a full assessment of people's income and expenditure, and as a rule of thumb, using open banking data to do that. And so that element of upfront assessment is really, really important. And again, when that is done through the sort of top up or repeat sort of borrowing, it's really important that that's done at that point as well. In terms of that sort of difference in terms of approvals, I think one really important element about the child benefit loans is that they're very small and very short. So often these are people coming through a loan cycle where they've either, you know, repaid a certain proportion or repaid the full amount quite quickly. And so that's why the acceptance levels we feel is higher, particularly amongst the child benefit loans, not necessarily against similar to the payroll loans as well. So I think that covers off the sort of the key bits around the approval differences, I would say.
Yeah, so I mean, again, from a risk perspective here, you know, in the example we looked at, the approval rates were in rank order. The approval rates were the highest amongst child benefit deduction loans, followed by payroll deduction loans, and then standard loans. Now, the theory would suggest that if you get a higher approval rate, then, you know, maybe the credit union's taking on more risk with the loans or whatever. But again, that's not borne out by this analysis, because, you know, not only are the approval rates higher for the child benefit loans and the payroll deduction loans, when it comes to arrears and write-offs and whatever, it's the child benefit loans that are actually performing better on those measures. So it's a more inclusive form of lending, it seems, from this case study, but also it appears to be a less risky form of lending from the credit union example that we have in the report. So again, it was designed to address this concern that, oh well, credit unions are not charities, they can't lend to everybody, whatever. We hope this report will give credit unions who do want to take on a slightly more risk or whatever, that perhaps you're not taking on that much more risk because of the nature of the way these loans are the way these loans are administered. So yeah, I think the approval rates coupled with the evidence on very low arrears and write-offs in comparison to standard loans, I would hope would give a degree of assurance for people who are thinking about doing this.
Great, thanks all. I'm going to move us on to a very different question next from Jason Eves at Knots and Links Credit Union, who says, many firms have a payroll loan offering with a commercial provider. They provide a great service to a small number of employees and are able to offer very low interest rates for A1 credit rated staff. How do we convince the firm that they should be looking at this from a staff welfare perspective, i.e. safeguarding a large number of employees from high interest credit, as opposed to a staff benefit, i.e. offering super low interest rate loans to very low risk, high salary employees? Finn, can I come to you with that question first? And I'm sure others will have thoughts as well.
Sorry, Holly, I was reading the Q&A. Can you remember which one are we talking about?
That's fine. So basically the question was, and these are all brilliant questions and they're very long and dense. So many firms having a payroll loan offering with a commercial provider, and basically how do we get that balance between actually for some of those commercial providers, they're basically really thinking of any lending offer they've got as a kind of a staff benefit, and how do we, I assume it means the sector collectively, kind of work with firms to convince them to look at that from a staff welfare perspective, i.e. safeguarding a large number of employees from high interest credit by partnering with credit unions instead. Finn, are you okay to start with that one?
Yes, thank you. Thanks for that. Yeah, so I think we've got some really good findings in this report about, well, obviously, firstly, that there's the impacts that customers are reporting to their well-being. People say they feel more confident managing their money. People say they are that they feel less stressed, less anxious, and there's of course the benefits to savings that we've seen. I think specifically we did ask questions around employers, and I think people it does have benefits to people's relationships with their employers. All the benefits that come to customers around better well-being and more confidence and savings are all things that employers will know will be beneficial for them as well. I think in terms of the difference with a commercial provider, we've what we tested here, as Gareth explained in the methodology, was looking at customers who tended to be from had a profile where they did struggle to access other forms of credit. We're also often talking about types of loans that you would struggle to get from a commercial lender. Sometimes like the very small amounts of credit, a few £100, things like that, that lots of commercial providers wouldn't do. I think we've also, there are elements of this model, as we're talking about today and talking about in the chat, like that you do have to be careful with, and we think the non-profit model of credit unions is leading to the good outcomes that we've seen in this research.
And Mick, thank you, Finn. Mick, I think you had something to add to that.
Yeah, I think it's such a great question. I wish we could do more to expand payroll savings with credit unions rather than other providers. Just to give you an example, we're part of an initiative in Scotland called Work and Save, and at the moment we've now persuaded over 20 of the biggest employers in Scotland to provide access to payroll savings to their workers. And again, we take the view that when you look at the sort of the way that the loans are, or the saving schemes and loans are administered, it has benefits for the employer, for the credit union, and for the worker. And we are picking up really good. We picked up some really good signs that, or some good research that shows that having payroll savings and accessible payroll-based loans is actually good for employee well-being, which has then consequential positive benefits for workplace anxiety and workplace productivity. So yes, absolutely, you know, let's do more to promote payroll savings through credit unions. You know.
Great, thank you. We've only got time for a couple more questions. So a few people have asked around kind of awareness raising. So Richard Munro at ComSave Credit Union says, Natalie, so that's one of the case studies we listened to, mentioned she was unaware of credit unions. Is there a role for Fair for All Finance to fund an awareness campaign? Richard, I'm going to assume that's a really lovely question that plugs our current awareness campaign kind of funding that we're doing. So some of you might be more aware of it than others. Kind of we really listen to the feedback from credit unions and CDFIs in particular, that actually lots of their potential customers, people who could most benefit from the kind of the lending and savings products that they have, just have never heard of kind of community finance, and have never, you know, kind of are looking for kind of more high cost lending, and that they really, you know, not thinking about kind of credit unions just because they've never heard of them. So from late last year, we've been working really closely with lots of community finance organisations, so lots of credit unions across the countries and most of the big CDFIs, to kind of basically raise more awareness with the press in particular. That's something we've been funding. We've had a reasonable amount of uptake so far with lots of kind of both national and local press, so TV, radio, kind of news. There's lots on our website if you want to know more, but we're really, really clear that there's a lot more that's needed, and we all want to see people in vulnerable financial circumstances have the best option for them, and we think kind of credit unions and CDFIs are a really key part of that. So the work's definitely continuing. If you're not already aware of it and want to find out more, please kind of go to our website, and that's your first kind of great point of call, and then there's kind of which of our colleagues are the best person to talk to. All of our email addresses and contact details are there as well. So I'm conscious that we're kind of running close to time, so I'm just going to do a couple of follow-ups and then kind of next steps. So we know we haven't been able to talk about or answer all of the questions. There's been an awful lot. There are nearly 100 of you kind of on the webinar. I think in particular there we know we haven't touched on all of the detailed questions from some of the debt advisors. So I think we'll have suggest a kind of a follow-up kind of there, because we do want to make sure that we've answered as many of these questions as possible. So please let us kind of regroup on that one and work out the best way of doing it. Those of you who've been pressing research on your screen will see that we've published the research kind of on our website, and I believe James, you're about to put a link kind of in the Q&A, so that'll be perfect. It's coming up there. So there's a kind of a link coming there, so you can kind of read the full research. As Mick was saying earlier, it's a very comprehensive report, but with a shorter exec summary, so something for everyone. I think, unless anyone's going to shout at me, no, great. I think I've managed to cover kind of everything. So if you've got any questions about the research, my colleague Finn is the best kind of first point of contact. And it just leaves me to say a huge thank you to Mick and Gareth for the research, incredibly comprehensive, and for kind of making the time to join us today, to Karen for all of your involvement in the research, and again for joining us today, and to my colleagues Max, James, Jake and Finn, who've done a huge amount of work to kind of make this happen. We really hope the research is kind of useful to lots of people. Please kind of get in touch with any questions if there's anything more you need to know. And I think perfectly on time, I'm going to close us off there. Thank you all.